Hello. In this chapter, we're looking at the income statement. Chapter 3, reporting operating results and the income statement. In Chapter 2, as you recall, we looked at the balance sheet. So we're moving to the other major financial statement that we work with, the income statement. So on our accounting equation, as you recall, the balance sheet basically showed us the three categories on the left. Assets are equal to liabilities plus owner's equity. In the income statement, we focus on the two categories over on the far right, revenues and expenses. When we subtract expenses from revenues, we end up with either net income if revenues exceed expenses, or we end up with a net loss if expenses exceed revenues. There are several important concepts that I just want to spend a few minutes talking about. I forgot to set my timer here. I don't want to go over the allotted time for the video. In the textbook, on page 96, it mentions operating activities. If you recall, when we looked at the balance sheet in Chapter 2, we focused on investing activities, activities or transactions through which we acquire long-term assets in the business. And we also focused on financing activities, activities or transactions through which the business accomplishes those investment goals or objectives. How does the business acquire the resources to invest in assets? And financing activities, again, basically focused on either long-term debt or equity transactions, getting money from owners. When we look at the income statement, our main focus is referred to as operating activities. Operating activities for any business, any organization involved in activities that have the objective of earning a profit are primarily focused on making sales or earning income through sales and incurring costs or expenses. And they kind of go hand in hand. Again, as I mentioned earlier, you pretty much do have to spend money to make money. So as we earn income or revenues through sales, we're also incurring various expenses of operating our business. On page 99, we talk about the cash basis of accounting. And I think it's important when talking about the cash basis of accounting that we also understand and really discuss in the same, talk about it in the same discussion, what's presented on page 100 of the textbook, and that is the accrual basis of accounting. So we have accrual basis accounting and we have cash basis accounting. Now, accrual basis accounting is the correct way of keeping books. It's the way that all the textbooks present accounting procedures and problems and so forth. We use accrual basis accounting. On the other hand, many if not most, especially small businesses, use the cash basis of accounting. And so it's an important discussion to have in any beginning accounting course. Accrual basis, which is the quote-unquote correct way of doing things, and the cash basis, which is not quite the correct way of doing things, of keeping books, but it is the way that many, if not most, small businesses keep their books, and it's an acceptable method of bookkeeping and accounting. I think it's a good idea to first mention a couple of things about the accrual basis of accounting. Under the accrual basis of accounting, we recognize revenues when they are earned. We recognize expenses when they are incurred. And so let me provide a quick example by way of a simple transaction. If we make a sale on credit, then we would the accounts affected would be accounts receivable and sales. And let's say that sale is for $100. So if we make a sale on credit, under the accrual basis, the exchange has taken place and revenue has been earned, and so that transaction would be recorded as a debit of $100 to accounts receivable and a credit of $100 to sales. Now at some later date, the cash for that sale, being that it was a credit sale, at some later date the cash for that sale will probably be collected, and so at that point in time we would have another transaction that would show that we have received the amount of that sale previously made on credit. We have received it now in cash, and we would record that by adding it to cash with a debit on the left side of the cash account, and we would show that our account receivable has now been received in full, and so we would credit our receivable account in the amount of $100. What we end up with is $100 added to cash. What we end up with, considering both transactions, the sale and the later collection, we end up with $100 added to cash and $100 added to sales, and our accounts receivable is zero. First we record the fact that our customer owes us that amount, and then later when we collect it, we record the fact that we have collected that amount, and so our receivable at that point in time is zero. This is a simple example of how the accrual basis would work. If we were looking at an expense transaction, let's say we received our utility bill in the mail for payment next month. Our utility bill for this month was received at the end of the month, and payment is due next month. Under the accrual basis of accounting, because the bill relates to services that we received this month, we need to show that expense. We need to record that expense and show it in our books this month. And so how we would do that would be to record a utility expense this month, and let's say it's with the cost of electricity being what it is lately, let's say it's $300. So we would add a $300 debit to utility expense to show that we have incurred that expense this month. Since we have not yet paid for it this month, we will be paying for it next month. We need to show that we owe that amount. And we show amounts owed with a liability. In this case, we can call it accounts payable. And so we would add it to our accounts payable account with a credit. So at this point in time, at the end of the month, we received our electric bill, $300, and it's due and payable next month. We record the transaction this month, we add a debit to utility expense, and we add a credit to accounts payable to show that we owe it. It has been incurred, but not yet paid. In the following month, when we actually make the payment, the way we record that transaction would be to show that cash has now been paid, and so we would record a credit to cash, or subtract the amount of the payment from cash with a credit. And in the accounts payable account, we would debit the amount of the payment to accounts payable. So just as it worked in the revenue example with accounts receivable and sales, it works the same way with an expense and accounts payable. The net of both transactions, after both transactions have occurred, what we end up with is a debit to utility expense and a credit to cash. And in accounts payable, we can see both the transaction to add it to accounts payable when we first recorded it, and we can also see the transaction to subtract it from accounts payable to show that we paid it. So as a result, after both transactions are recorded, accounts payable is 0 for those two transactions. And again, we end up with a debit to utility expense and a credit to cash. Again, that's how the accrual basis of accounting works. And these are rather simple examples, but they basically show how it works. Now, if we were using the cash basis of accounting, it'd be a little different. Under the cash basis of accounting, we do not recognize revenue when it is earned. Instead, we recognize revenue when it is received in cash. Likewise, under the cash basis of accounting, we do not recognize expense when it is incurred. Rather, we recognize expense when it is paid in cash. So for both of these examples, the first transaction, when we recorded sales and accounts receivable, or when we recorded the expense and accounts payable, neither of those transactions would be recorded under the cash basis of accounting. Rather, the transaction for sales would be recorded later when the sale was actually received. And so at that point, under the cash basis, we would simply credit sales and debit cash. Similarly, for the expense example, we wouldn't record the expense when we receive the bill. In other words, we don't record it when it is incurred. Rather, we record it when it is paid. And so for the expense example, we would debit utility expense and credit cash when that bill for utility services was actually paid. I hope you find this helpful. Thank you very much. We'll be back for another lesson in a few minutes.